The optimists, if you go back, were people who thought that risky shares would give them higher returns, and they triumphed over the 20th century.
Whenever people quote average stock market returns, it's probably Elroy Dimson's data that they're using. That same data formed the basis of the landmark book The Triumph of the Optimists, and now covers more than 125 years of market history. Not just that, he also created the FTSE 100 index and advised the Norwegian Wealth Fund.
And do you think that period, the 1900s, was exceptional?
Looking forward from where we are now, people should be anchoring on numbers which are lower.
Yours is the gold standard of research.
And you can't keep saying that.
I'm not just saying that.
Say it again.
Say it again.
Stop, don't stop.
The gold standard. So the latest version of the research is 125 years, but correct me if I'm wrong, it started with 101. Is that right?
Well, we started with our first publication as a private publication. And so for that, we had data which ran from 1900 to the end of 1999. But that publication was quite successful. There was a follow-up. And then Princeton University Press asked us for a larger report.
Is that the Triumph of Optimists?
Triumph of the Optimists uses data up to the end of 2001. We'd actually started with a launch for the beginning of the year 2000, and that had data which obviously had to end at the end of 1999. So there was a soft start to all of this. We didn't realize how big this project would become.
So for those that don't know this work and the Triumph of the Optimists, could you give us a summary of what you set out to do and what it is you found?
We started out knowing a bit about long-term US stock market history. What we set out to do was to generalize that so that we would know what had happened to lots of countries, including ones which had not necessarily performed as well as the United States. What did we find? We found that the US equity market had performed very well compared to other equity markets around the world and compared to fixed income or cash in the home market. So those were, I think, the absolute core of our year 2000 research initiative.
Yeah, and so it started before then because you didn't like the UK data that already existed. Is that correct? So that was the origin of your work into the UK market.
But the origin of the work for the UK market were coming up with a new index for Britain. And lots of people knew that the Financial Times 30 share, which was well known, was a pretty poor index. What it had going for it was a long history. And so Paul Marsh and I were involved in the design of a new index, which was potentially going to be 50 shares, 200 shares. We messed around a bit looking at the properties of the different ways we could do this. And we came up with a 100 share index for the UK with a back history. So we'd done that. In the mid-80s, we launched the FTSE 100 index, which still continues. And then a couple of years later, we got drawn into creating a small cap index for the UK, which is still continues. It's not part of what London Stock Exchange Group do. So we'd had a bit of practice during the 1980s at creating indices. And so we gradually became more confident about collecting data and infilling. And sometimes it was possible to do things which we hadn't dreamed of. So for South Africa, for example, the data that somebody else had collected was a South African academic, and his data began in 1940. But he gave that to us for us to use. But we wanted to start at 1900. But it turns out that all the South African companies that were of any value were traded not just in Johannesburg, but in the early parts of the 1900s in London. So we were also able sometimes not to have to travel somewhere else, but to do the work locally. So some people call this financial archaeology.
That's a wonderful way of saying it. I guess we need to talk about that process then. So you say that we didn't have to travel there. in certain markets, you have to physically go to the place and try and hunt out the
Oh,
information.
yes. Mike Staunton went to New Zealand and managed to flesh out data that we had for New Zealand. We, at a somewhat later stage, had been collecting data in Austria, and the person who we took on to work with us, who was somebody who was doing a PhD in finance in Vienna, he already had a PhD in computer science, but now he was doing a PhD in finance, which is sort of, at the time, of greater commercial value. The world's probably changed since then. So we arranged with the stock exchange that they could have ladders that would take up this very, very tall room, and they could look at the copper plate handwritten records going back, and there was data available for Austria. That was not very far away, but dusty and probably looking for the first time in half a century at some of these sheets of paper.
It's like Finance Indiana Jones, isn't it? It's pretty cool. It's like looking for these secret things inscribed on library walls and stuff. How I made a video, and I know you've watched the video, and I talked about survivorship bias, and I know that was a key point around your UK data set. You basically explained that the previous data had survivorship bias built into it. But when you're going to Austria and looking at a wall and that's your record, is that not fraught with survivorship bias, or you don't know what you're missing, or that wasn't engraved on a wall?
It wasn't engraved on a wall. There were books that were stacked up.
I thought you said there was brass plates or something at the top.
No. You climbed up a ladder. Mm-hmm. You weren't doing that to look at people putting prices on the wall. They were just books where they'd kept records.
Okay.
And so there were shelves high up. And the then PhD student, who's now a professor in Stockholm, he had a smart idea. He'd take our support and encouragement and then find the best person he could who would actually do a lot of the transcribing of the data. So sometimes there were spin-offs out of these, which were quite unanticipated. So the research assistant was so good that he married the research assistant.
Nice. Two birds, one stone.
Yeah, work and pleasure, business and pleasure. Just to clarify your survivorship bias, in case people don't know what that is, that's essentially the idea that some companies they might have gone bankrupt, or they might have merged and it wasn't reported, or certain things were lost over time, and we only have the companies that remain. Is that correct?
So sort of. I thought the analogy in Damien's example was good, and so people who are viewing this should go back and look at what you did, what you put up a couple of weeks ago, maybe more than a couple of weeks after people view the edited version of our discussion. So what does a survivorship bias look like? There's one crucial thing which is illustrated by the UK, and that was that when people decided that it would be good to have a back history in the UK, they put together a 30-share index. It had a number of drawbacks in the way that it was calculated, but the data that they used was companies which were important in 1955. But they wanted to go back further, and they went back to 1935 and wanted to minimize the extent to which the index constituents kept changing over time. And so it seemed sensible at the time to make sure that to the best they could manage it, when they went back to 1954, 53, 52, 51, they were the same companies. So they left out companies which would have been in existence their start date, which is the end of 1918, those were missing. So all the companies which existed then and were destined to go bankrupt or to have very poor performance didn't appear. So this had built-in outperformance. Now, there were other problems with the index, so the method of calculation was not something that you would want today, although the index is still produced. It's just having this month its 90th birthday, but it's a funny index. So that's part of the survivorship bias, was creating a back history of surviving companies. Another sort of survivorship bias is the survivorship of markets. So, for example, if a market became near valueless, people would not have been able to get any enthusiasm for collecting data on that market. And so even if we go to the period of the sort of 70s and 80s, when new market indices came into existence, it was because somebody said, yeah, we really ought to include XYZ country. And that would be a country which may have seemed unimportant some years earlier, but had done well. If, on the other hand, there was a country which had done very badly and its stock market had crashed, that would tend to get overlooked. So there's also survivorship of markets.
Russia was a
Well, Russia, you
market.
didn't have a choice. So that died. And so for that one, we made sure that we collected data on Russia through to the 1917 revolution, at which point we deemed the values to be zero. So there were businesses which I suppose had some value, but no value to investors. They were businesses which were appropriated by the state. And the same happened in China. Those are the only two cases where we have an incomplete history. But the problem with survivorship is a big one. And you expressed it very well in the previous session that you'd done a few weeks ago.
I was crapping myself because I was like, I know you're going to watch that video, and I hope you agree. As I'd say in the video, yours is the gold standard of research. And
you can't keep saying that.
I'm not just saying that.
Say it again.
Say it again.
Stop, don't stop.
The gold standard. Yeah, I'm not just saying it to flatter you. It is the best we have. But, you've said there that we have complete records, or there's only two markets we don't have complete records for, China, Russia. How can you be confident that you have complete records if records didn't survive? You don't know what you don't know.
We have a record which is complete in terms of time, but not comprehensive in coverage. So every so often, somebody will research a market and come up with something which looks better than what we've got. So that is slightly different from a market which subsides and then reappears. The most challenging period was linking Germany up to World War II and then beyond World War II. And there were some financial historians who had gone back and focused just on the companies which had been in existence in Nazi Germany, about a tenth of which ended up in East Germany and were a little bit like those Russian stocks. And 90% ended up in West Germany, and they traced through what had happened to their values and so forth. So we were able to bridge a history which ran up to the Second World War. Some of those prices are the best we can do, but some of them were controlled. The prices didn't fluctuate very much, and the people who write on this basically say that the Nazi regime just en passant ensured that prices looked stable. So there are difficulties sometimes with the data. Once you start averaging this to get an annualized return over a very long period, and once you have a large number of countries, those things make relatively little difference to the figures that we report.
So you find that because this is why you release an annual version, because you're constantly adding markets, trying to improve the data collection methods. I know you've got the returns data there. So could we just go through some of the equity returns across the globe between 1900 over that initial period and in the most recent decades?
Well, if we want to compare across countries, we have to go into common currency. So the common currency that I'm moving into is the US dollar. But if we looked at comparisons, it would be much the same if we chose some other safe currency like the Swiss franc. What we can't do is work in nominal terms because the impact of inflation varies so much from country to country. Inflation rates were thousands and thousands of percent in the hyperinflations that Germany experienced, for example. So let's look at the two examples where we focus on individual countries. We've talked a bit about the US, and what we can also think about then is what the average of all of the individual countries look like, and their stock market returns were in real terms 4.8% annualized. And in real terms for the world index, which is heavily tilted towards the US, somewhat higher, 5.6%. If we look at what happens to the bond market, the long-term government bond market, that was a terrible thing for the average country over the course of the last century. And this time round, it's not been so bad. But the transition from looking at individual countries to looking at the world market is dramatic, and risks go down from being invested globally. For most people who are listening, the best thing to do is to diversify globally.
Do you find that when there are changes and you go, oh, we got that wrong, this is now better, it doesn't really move the needle in terms of the performance?
It doesn't move the needle on the world index. But unless you are fixated on being as good in quality as you possibly can be, then things will slip. If you don't try to be better all the time, you end up becoming worse all the time. And that goes for data compilation as well.
I think, are you at 33 markets now? I know it's around 30, 33 to 35.
Yeah. Well, it's creeping up, 35.
Yeah, and five asset classes, is it? Or five asset, like bonds?
5 asset classes, and then periodically we will write an essay on a particular theme, and so we'll bring in an asset class where we don't have year-by-year data that we wish to keep extending. We've written on real estate, for example, covering quite a large number of countries, but we don't update that every year. We've written on artworks and collectibles, same sort of thing, getting esoteric data series, which will tell an interesting story and will enable us to write something which appeals to people at other times. Other sorts of data are very easy, gold, silver, and so forth.
I know you're desperate to ask something.
I'm itching. Would you consider adding a 6th asset class, Bitcoin?
No.
Why not? Because, I mean, it has been, I guess you say, the best performing asset since its inception. So,
well, that would be an added reason for not doing so. That would be a close cousin of survivorship bias. It's called success bias, picking in something because it performed very well. But the answer is that we don't have much data on Bitcoin from 1900, 1910, 1920. We've only got a tiny bit of data. And the whole purpose of collecting a long-term data series is to enable people to escape from looking at the last decade, but to take a long-term perspective. So the answer is no. It's not antagonism towards modern research and so forth. It just doesn't fit with the long-term perspective that we take on our data set.
So, Mr. Akerele, I hear you are a salesman.
Elite salesman, yes.
One of the best, they say?
I've got a little bit of experience in the game, yeah, I could say.
Done a few deals.
I bill.
What would your compliance team say about you?
They would say that I am always nagging them, and that essentially I have beef with compliance. I love the team. Compliance slows down all my deals because every time I get to the finish line, they've got to check documents, KYC, GDPR, and it's just a nightmare. It slows the deal down by like 2-3 weeks.
It's
sometimes.
always on both sides as well, isn't it? Sometimes it can be block on the other side.
Exactly.
Well, that's where today's sponsor can help.
Indeed. Vanta helps companies of all sizes get secure and compliant fast, and they stay that way.
They do it by automating compliance with over 35 security and privacy frameworks like SOC 2, ISO 27001, and HIPAA.
Yeah, all of them. And this saves businesses so much time and money.
According to a recent IDC study, Vanta customers save over $500,000 a year in costs.
Not bad.
And they also help you complete security questionnaires up to 5 times faster, which is great because everybody hates filling out forms. If you're a business that needs to prove security and compliance, visit vanta.com/making money to sign up for a completely free demo today.
So how long would it take for you to put Bitcoin as a new class? Would it be like 100 years? Would you wait 200 years?
If I had to think about other asset classes which are sort of alternatives. We've had debates on and off on hedge funds and other sorts of assets, and even for hedge funds, several decades is really not enough. So let me explain why you need a lot. Just imagine that you want a view as to what performance you might get from investing in long-term bonds. If you'd invested in long-term bonds a year ago, 2 years ago, everybody would agree that doesn't tell you anything. But if you go back 10, 20, 30 years, is that good enough? Well, if we go back to several decades ago, interest rates were running at the order of 16% or so. I'm talking about British government bonds. And now they're very low. And so when interest rates come down, people will pay more for their bonds. And so we're now in a position in which it looks as though you made money from bonds, but you made money over a period while interest rates were coming down. So if you want a long-term view, you need to go back not 30 or 40 years, but much further. So Bitcoin, well, if we were able to go back to early days and other attempts at alternative assets, it might tell us something. But there's only been a small number of attempts at that, except for looking at precious metals.
Do you think then that the Bitcoin is good because you're basically saying there's not a long enough like data set here to compare it, but then do you think that going back is a useful comparison, and do we ignore the modern world if we compare ourselves to, say, the 1900s or post, the gold standard being removed? Are we in a completely different place as an economy that it makes it futile to compare us to the early 1900s?
I think you can learn something from history, but you've got to be aware that there are potentially drawbacks to that. If you were to think back of to one of the things which you also talk about, which is mutual funds, you talk about the performance of a mutual fund over a period of time. But the stocks which are in the mutual fund today may be almost entirely different from the stocks that were in the mutual fund 20 years ago.
Yeah.
And you don't worry about that. You just say, well, that's the history of this fund. And the same is true for a stock market. The stocks which are in the US or the UK or some other country's index are very, very different from what they once were. And you may want to come back and talk more about that in a while. And so if we were looking back at history, we've got to ask ourselves, what do alternative assets look like? Whenever you do that, there's a problem. So there's always a bit of success bias as well as survivor bias in all of this.
Like Lego, right? I constantly get told that Lego is one of the best. Rare Lego sets are a really well-performing asset class. And
well, there is a study done by a Russian academic, and she collected Lego data. I think it was when she was doing a PhD at London School of Economics. And there is a Lego series, but there isn't a Playmobil series or your 12-year-old. What is your 12-year-old?
Pokemon cards, right? So that would be the thing. But for every Pokemon card, there's another, Tazos or Pogs or something.
All these new things they're these little toys that people attach to their handbags. They're like these little fluffy things, and you open the packet. They're like going viral.
Well, Beanie Babies were massive at one point, weren't they?
I once, when I was running the master's degrees at London Business School, we had one candidate who had paid his way through, having come from Europe, with the only money he could make. And I was trading Beanie Babies. And he had paid for a 3-year degree as a foreign student by trading Beanie Babies when they were really hot.
Wow. So if you were bringing in Pokemon cards, would you encourage people to say, well, you've actually got to look at all the others that failed as well, like the Beanie Babies and these things? Because by just looking at Pokemon cards, that is survivorship bias. Yeah. That's the one that lasted.
Yeah, and if you ask your parents' generation, or if you've got grandparents around, What people collected? Well, it was stamps. And we've done a study of the of investment quality postage stamps, which had done quite well over the long term, but in recent years they've fallen out of favour.
Penny black, is it? The penny black, is that the
Yes.
stamp that everyone wants?
Yes.
Yeah. How confident can? Because one thing I think, people pick up your work and then they quote the average, and I think a lot of people think that that is like etched in stone on those walls that I was talking about before, that it's a matter of certainty, whereas obviously what you're communicating is that there's this process of data collection and it's ever changing, and that's why you constantly look to improve it.
It's the best we can do, and one might change heart, have a different view if it emerges that there's a problem with the data. I'll give you an example in a moment. Or it might be that things change over time. So let me give you an example of changing your mind. For the US data, going back to before the standard data set that began in 1926, or that covers data from 1926 onwards, going back earlier to the 19th century, there's a longer term series, and that left out a company which appeared, grew big, and then went bankrupt. It was called the Second Bank of the United States. 2BUS was the abbreviation. And that got to be about 30% of the US market, and then became essentially valueless. And so if you took periodic scans of the market, you could miss it. And it was missed when people collected data. They overlooked that. So that can change things a bit. But the main thing that influences confidence is how things vary over time. There's no golden rule for what the performance of equities will be, whether it's the nominal performance or performance relative to inflation or performance relative to bonds or relative to treasury bills. Those numbers change over time. In some ways, some of the changes are a little bit predictable. We might or might not come back to that later. But we've got data over a longer period now than we once had. And looking at the US and the UK going back not to 1900, but going back to 1800, it's clear that at that time, equities did not give you a large premium compared to fixed interest investing. And that's something you've got to factor into thinking about the future. And so when we think about what the 21st century will end up looking like, I think our best guess is that will be a lesser performing equity market than the 20th century. Or so far, what we've got is evidence on the 19th century and a bit of the 21st century. That's not as good as the 20th century. So I think when it comes to extrapolating from the data, that's very important, and that's more important in some ways than the question of accuracy or whether a company got left out.
Yeah, I think so. This idea that the 1800s, that bonds may have outperformed the stock market, just kind of challenges the idea that equities always win. And there's this period that didn't, and so we could have that again. And do you think that period, the 1900s, was exceptional?
Well, I think that US data that you're referring to has some drawbacks because it's a comparison between equity performance, stock market performance on the one hand, and bond performance on the other. When we do that in the UK, and that's something which I've done with some co-authors, we compare equity market performance with government bond performance, and there is a premium that equities earned. If, on the other hand, we do it for the US, there were no government bonds because the US was a set of different states for much of that century. And there were winners and losers amongst the states before there was a United States. So there was no government to issue securities which were safe. They didn't control the printing presses. And so the bonds which are used as a proxy for government bonds in that American research contains corporate bonds, municipal bonds, anything which looked low in risk. But if you're comparing equities to bonds which are not risk-free, then the bonds which are not risk-free should earn a risk premium.
Yes.
And so the gap between the two will not be as big as it would be in a country where the bonds were truly risk-free. So our evidence for the UK suggests that there is a modest premium from equities compared to bonds, even though that was not the case.
I'd known that, because that's a great point. Because those state-issued bonds...
I brought it in print. I'll give you the article.
Yeah,
and
amazing.
It's very recent, but it is published and has been peer-reviewed.
Because those state-issued bonds, it was literally the Wild West, right? So it was a bit more... It wasn't... We don't have the backing of a nation that can't go bankrupt, essentially, where we're a bit more confident in the fact that the US will pay its debts as a whole. But on the state level back then, potentially not. So they were riskier than the bonds we have today.
Well, I think also equities may have been safer, because a major part of the stock market in both the US and the UK were railroads. Mm-hmm. And the railroads controlled a revenue flow and had monopolies, and maybe at that time were relatively safe.
So the equities were the bonds of the time, in the sense of they were a safer asset class.
I don't want to push it too far.
Yeah. But it helps reframe it. So what you're basically saying is, though, that the risk premium, this point of if you take risk, you should be rewarded in the long run, that has persisted over hundreds of years, potentially.
We believe it has persisted, but with a lot of variability. The reason that you should expect an equity risk premium is that equities are risky. If they're risky, bad things may happen. And it's because of that you expect, on average, to get a reward. But over a 5-year, or 10-year, or 15-year period, the very nature of that risk is that you may do badly. If there was not a chance of you doing badly from equities, then they wouldn't offer a forward-looking risk premium. So you sometimes see these charts of what the equity premium was, the realized excess return of equities compared to bonds, over rolling periods, and you find sometimes equities do worse, sometimes they do better. We really need a lot of data to form a judgment about that.
How much data? I know in the briefing call you threw some quite big numbers around in terms of what you think would be acceptable amounts of data.
I think in the end you have to fall back on some intuition as to what was going on, but these equity risk premium numbers are used around the world for setting allowable rates of return, so setting the rate of return which it is reasonable for a railway company or a water company or whatever to charge to recover what look like reasonable returns for shareholders. And that I think means that those numbers are fearfully important, because people take them. And if I ask you, what is pi? You can tell me it's 3.14159265358 something like that.
I'd have stopped at 1.4, but yeah.
But it's a number.
Yes.
The equity premium is the pi for financial mathematicians, and it's not a constant like that. It can vary over time. So people look for great precision in these numbers, but they're only a starting point. But in some locations, those starting points become very important. They influence what financial regulators permit for making projections as to what the returns will be for investing in the sorts of products that you talk about when you talk about your favorite index funds. Mm-hmm. So they use those numbers and anchor to them. My take on it would be that looking forward from where we are now, in the beginning of the second quarter of this century, that people should be anchoring on numbers which are lower than we saw in the 20th century and documented in our Triumph of the Optimists book.
So T, recently we had a conversation with tax expert Dan Needle, and I think one thing that became very apparent is you're going to have a real big crypto tax bill.
I am.
What are you going to do with the money, mate? Where are you going to put it?
I don't know. Like every year tax season comes around and I'm stressing. I'm like, how much is my bill going to be?
I'll tell you how I do it. What's important for me is that money, that tax money, is completely separate to every other bit of money in my life. Because otherwise I start counting it as mine. I start locking it away in the stock market or whatever. So I use a tied instant saver account that's just attached to my business. And I just put the money in there and keep it in there. And that's solely for the tax.
You can just ping it over to tax man when it's tax time.
I just know it's allocated for, and the stress that takes off me is worth its weight in gold.
Every January I'm stressing.
Check that out, mate. We've got a bit here actually about how you can check it out yourselves. I'll let you read it out because you're the best at reading.
I mean, I'm the star reader of the show. If you're a sole trader or company owner, check out Tide. New members can get up to 4% AER variable for 6 months. I say up to because it depends on how much you deposit in your account. The more you save, the higher the rate.
You can get this deal, plus you can get £100 cash back if you fund your Tide Instant Saver account with £5,000 in the first 30 days. You get that by using the code MAKINGMONEY. Terms and conditions apply. The code is Making Money, all one word, and you'll find the full terms and conditions and all details of the offer in the description below. The variable rate is correct as of the 7th of August, 2025.
I was about to ask, you always see written, past returns are no guarantee of future performance, but how can we put so much faith into, as investors, not as academics, how can we put so much faith into past performance numbers and average when the beginning of this since 2000, the returns haven't been quite as good? And also with all the changes in the stock market, how can you really have so much faith in these numbers, especially in a time of like American exceptionalism and all these things? How can we think like the next century will be similar to the last century?
We shouldn't. I don't know where the phrase comes from, but they talk about history not repeating, that history rhymes.
Yes.
And I think there are ways in which we can choose history as our starting point. So if you were guessing the weight of some items, for example, there used to be a guess the weight of the cake competition at the local primary school at the end of our street. And I won that once. So you had to write things down, and they passed you if you arrived late, the sheet of paper with everybody's guesses above it. I have no capacity to guess the weight of a cake. So I eyeballed the numbers and I wrote down the average. And a short while later, they broadcast who the winner was. This was their name at the bottom for this. It was just that I thought that the average would be helpful. So that doesn't mean to say that I'm fearfully insightful. And I think there's something similar going on. If you want to know what the equity risk premium might be, you would ideally like to average everyone's thought processes. You can't do that. But you can look at history. So it gives you a starting point. And then you've got to ask yourself, well, what's it going to be like going forward? In Australia, which is a winning stock market over the long haul, there's quite heavy reliance on the very high returns that have been achieved. So when there's a company which is being regulated or being told by its regulator how much it's reasonable for shareholders to earn, they like those big numbers. But if the numbers are very low, suppose you take a stock market which has just subsided, Argentina. Nobody in Argentina says they would look for returns from equities which are negative. It's just that the country did badly. So I think that history is a starting point, but you've got to be quite cautious about it all. And once these numbers get used by regulators, you've got two sides to this. You've got the regulator and the regulatee, the regulated utility. And things can go wrong, as we've seen in the news very recently, or at least as we speak now, very recently, that regulators can get things wrong and get wrapped on the knuckles.
I would like to ask you around how you feel American exceptionalism has surprised you in your research. Do you feel that this is a force that can continue? And if it doesn't, what does that do to someone like me who's globally invested?
Well, to talk about American exceptionalism, let me go back then to before we had published our book, Triumph of the Optimists. And at that stage, just about all of the business schooly textbooks in finance would have a chart which showed what the long-term history had been for investing in the stock, bond, or cash market in the United States. And that would be in an edition of a finance textbook, which might be in Hungarian or in French, whatever. And so our intuition on that was that we shouldn't really be relying on evidence for the US. We should be looking elsewhere. And so we need to deal with the question that the US had done very well. We called our book Triumph of the Optimists because the optimists, if you go back to 100 or more years ago, were people who thought that risky shares would give them higher returns. And they triumphed over the 20th century. And we called it Triumph of the Optimists because people investing in shares had done so very well. It was a sort of caution that you shouldn't expect that to continue. And where had they done well? More than anything else in the United States. So the US was a very high-performing market, and it seemed obvious that one should not be projecting that the US would continue to outperform, because if we all agreed that America will do well, prices will go up to the point at which they're at a new level, but you wouldn't expect further outperformance. So we don't make forecasts. We are evidence-based researchers. We presented the evidence and the reader can make their mind up. But what actually happened was that the US market, which you thought would be much more average going forward, ended up performing very well in investment terms. So the first quarter of the 21st century was very good. And when we started doing our presentations of the 1925 edition of our book, we ended up showing what the results looked like. And then we added on a little chart showing just what had happened in the first few months of 2025. So it continued to look good momentarily. Then there was a big dip. Then there's been a recovery. Who knows what the second quarter of the current century will look like? But the notion that America should continue to do well because it's done well in the past, that's a very American statement of sort of optimism about the future. A lot of Americans believe that. But nevertheless, over time, the proportion of assets held by American institutions in non-US companies, for pension funds, for example, has declined a great deal. They used to have nothing in overseas securities and now have a substantial proportion, over 20%. So there was a belief that investing globally would make sense for Americans. They were wrong. But you can sometimes make correct decisions and then you turn out to be unfortunate. And those who stayed in America did better than those that invested globally. What would we expect looking forward? We don't know which markets will do well. What we do know is that if you diversify, you end up with somewhat less risk than if you don't diversify.
You have, it's probably my favorite chart, is that wonderful like flow of markets over time and shows the impact. It shows Japan bubbles up in a period and then declines in relevance, and the fluctuations of the market impacts over time. It shows this slow death of the UK from 25% to 4%. If, as we are now, where the US market represents about, say, 60%, 65% of a global index, if America does decline and someone is buying the whole index, what would that do to their returns, do you think? I mean, do you have a way of saying, is that going to be a really painful process for that individual, or would the rest of the world pick up America's slack?
Now, let's be clear-headed about what happens when a market drops in price. Then if cash flows haven't changed, then our expected return looking forward will be better. So as we look back, prices drop. When prices drop, you will do better going forward. So we don't know. People making international asset allocation decisions are influencing that. You're not influencing that because you've publicly posted that you don't think about any of that stuff. you just buy the world.
Yeah.
And I'm very sympathetic to that point of view. But there are people who are thinking about the performance of different countries. And what you see is a kind of weighted average of all the opinions that investors and other professionals have.
You say that index investors have gotten a free ride on the people who perform price discovery. So these people who think about it, people like me, have basically ridden on their hard work. Do you think there's a point where the index becomes too big or too much of a problem, that it kind of overweighs the active component?
Well, there is an argument that now is a better time to be an active manager because there are so many people who are just clinging to the index. But what you're focused on, I think very wisely, is doing all of this on the cheap. Mm-hmm. So what every investor wants is some exposure to the market. We sometimes call that return beta. And you also want some alpha, which is outperformance. Now, alpha from being clever it's difficult to get right. People make mistakes. But there is one form of alpha about which you can feel very confident. That's negative alpha. The more you pay in fees, the more you will be adding a negative amount to the return that you get from the markets in which you're investing. So you're taking a bet on alpha. You are projecting large costs for some investors and low for yourself. And as you pointed out, those costs are becoming extraordinarily low for people in some mature markets, especially the United States.
I'd never really thought about it like that. I've always described it as, the only thing we can control is fees. So we should try to reduce them. But this idea that, you can generate an outperformance through reduction of fees. And by betting on someone who says, I'm smarter than the market, you're sacrificing that certainty of return by basically saying, I'm going to pay you an extra fee to try and be smarter, but that's uncertain and pretty hard to do.
It's hard to do. There are clearly talented people who have great insights. You may pay quite a lot for that. So if you really want the people with the best insights, they're probably people who work for hedge funds, and you've had one or two of them on your show as well.
They all say, this is the year the actives are going to win, and they don't. Could I be as bold as to ask you how you invest or how you see, asset allocation for yourself?
We are heavily invested in the one of the Vanguard global funds. So, I had known Jack Bogle a little bit.
That's the name dropped out. That's so good. That's so cool. I've never met anyone who's known him personally. So, yeah.
So, well, I had been, just when my PhD was finished, I'd been at the time visiting in the US and became aware of the startup of index trading. But didn't invest through that route because it's complicated. And anyway, I didn't have much money to spare. But so we're invested with Vanguard. You highlighted a lower cost, but less widely distributed alternative.
Oh, you really watched some of the content. Thank you very much. Yeah, I think at the time, the Invesco fund you're talking about, which was a global fund. It's got much bigger now, but I mean,
it's a titiller. I think the uncertainties of a small fund have to be in people's minds at the same time as a different headline cost. But it costs us so little. Mm-hmm. It
0.2 on a Vanguard.
Nowhere near as much as that.
Well, are you buying through a US?
No. Buying through, because I started investing early. I was on the chairing the policy board at FTSE Russell, which is part of the London Stock Exchange Group. And the person who used to sit beside me was the European head of Vanguard. And so I was an early investor as a retailer.
Sweet connection.
It was it was not a special deal, but the only way of doing it was as an institutional investor. And he just opened the door for me, but there was absolutely nothing special. This is not like Tony Blair's wife getting her clothes at a discount. That was in the morning's paper, if you missed that. There was no special discount, but it was just remarkably low. And yet there are lower cost alternatives to what we do. I'm very much in favor of investing for the long term. But just to go back to the earlier question about not being clear on when performance will be good and when it will be bad. Yeah. I think the best people to invest for the long term are ones who hope for good outcomes and can live with lousy outcomes. So if you were saving up for children's school fees or something like that, your timescale is not very short, but it's perhaps not that long. If you are saving for grandchildren, or you've got more money than you need and you visualize this going to charity or whatever, then you can take a very long view. And so I'm all in favor of equity investing and a low fixed income content.
Yeah, and you're saying that you expect the returns to be lower, or if you had to make a bet, you don't like to forecast, but you say people should at least build into their minds that the returns of this century could be lower than the last. Do you still think that you'll see that persistence of equities, the risk premium, and them outperforming other asset classes? And even though it's low, it's still going to be potentially the best bet.
Yes, over the long term, and probably. Mm-hmm. So if I think in terms of my current employer, which is the University of Cambridge, you have some very wealthy colleges, super wealthy colleges, and they can afford to take quite risky investments in the hope of high performance. And then you'll have some much less wealthy colleges. They're ones that came into existence relatively recently. For them, if they didn't have the money to repair the roof over the organ, the costs would be just too much. And so you can't have that money that may be needed if you're unlucky with the weather and the rest in the near future. That has to be invested rather more safely. So the investment world favors the already wealthy. And it favors the already wealthy, who include people whose time horizon is long because they've given money away. So the college that has received gifts is a college which can think about things over hundreds of years into the future.
Yeah, this leads me on to your work with sovereign wealth funds, which I think are like a fascinating instrument and some really interesting insight. Did you work with Norway's?
I worked with Norway. I chaired the strategy council for Norway for quite a long time. Norway decided that once money started coming in from the relatively recently discovered reserves under the sea in the North Sea, that the money that had come into the country from oil belonged to the people of Norway, didn't belong to wealthy rulers. And so they set up a structure. I think that's very important. You need some sort of structure, otherwise people make knee-jerk decisions. Money initially was in cash, then it was held in bonds for a few years until it got a bit bolder and they moved into equities. And there was heavy reliance on the early work we'd done, actually before publishing Triumph of the Optimists, the privately published books that I told you about. And so I got drawn into Norway, giving some guidance on what performance looked like over the long term. And then found myself, after a few years, chairing the Strategy Council. Now, the Strategy Council is not an asset manager's strategy group. I was doing this for the owners. The owners are 5-point-something million Norwegians who delegate to their government, and the government delegates to a department which is the Ministry of Finance. So my role was thinking about the big picture questions with other members of the Strategy Council. And I spent quite a long time doing that and thinking about how one might invest. And I must say that the option of going to an index fund provider that is truly global and has securities all over the world, that's essentially what Norway does as well. When you are that big and that wealthy, when you own about 1.5% of the equity of every company in the world on average,
Wow.
you don't spend your time worrying about whether a particular company is going to do well or badly. You think about the big questions, and that's how we started out.
Is it the largest sovereign wealth fund on the planet? Is am I right in saying that?
There are two very large funds. There's that, and then there is the Japanese government pension fund, which you might regard as being in the same sort of league. It started later and grew fast. But as a pure sovereign wealth fund, it is the biggest.
And they're globally diversified through equities as a large
Globally
portion.
diversified, but interestingly, in the early stages, they were gradual changes. So there were questions like, how much should be in Norway? How much should be in Europe? How much should be in other countries? The answer on Norway was nothing. And they set up a separate Norwegian fund that would invest in Norwegian stocks, because otherwise this huge global fund would just swamp
We should do something like that. We should do something like that in the UK.
Well, we should have with the North Sea oil, because we had the same. Were you pulling? Were you despondent at the time that you were doing this work with Norway, and you were looking at the UK, going, "Why are we not doing this?"
The UK's failure to take advantage of its oil was somewhat earlier than all of this. And my involvement was after we'd produced our first book in 2000. But I think that that sovereign fund is very focused on governance. That has some upside. People who are the owners, that's the 5 million Norwegians, know exactly what's going on. If you look at other countries, they've very often gone for other sorts of strategies. So some will spend on infrastructure and say that's for the good of the people, and they'll build roads. Or there may just be a setback in the local economy, and they'll draw money out to help on that. What the Norwegians have is a spending rule. And the spending rule used to be 4%, it's now 3% of the fund, smoothed over time. So that is like saying, you've got the good fortune to have chosen your parents with great wisdom. They've left you a trust fund, but your parents don't really trust you to be let loose with your trust fund that they've graciously bequested to you. You can spend just a small amount each year. So
which should be under the returns, I'm guessing.
Yeah, it's like the Trinity study almost, isn't it? It's like the 4% rule or something. But it's genius, and so they think so long term, and it feels like a lot of things we lack in here. I would have the foresight to protect it for future generations is great.
But what they do not describe it as mimicking or doing something different from Britain. When the structure was set up, it was to avoid Dutch disease, not British disease. The Dutch disease was that the Netherlands found and exploited oil somewhat earlier than the Norwegians. They had a lot of money that came in, and there was domestic inflation. People felt wealthier. They spent a lot in the Netherlands, and the Netherlands never really achieved the sort of ultra long-term benefits that the Norwegians decided that they wanted.
At the minute, the UK is trying to create a system whereby auto-enrolled pension schemes create almost like a home bias, or they're pushing them towards putting a certain percentage of their holdings into UK assets.
Yes.
I read a paper recently as well that argued that a home bias is a good thing for domestic investors. That there's a guy called Ben Felix, he's a great YouTuber, and he presented this idea that this paper put forward that you should have 25% of your pie in your local market. Do you think these kind of approaches make sense when you're talking here about global investing?
No, they're wrong.
Okay, I'm glad to hear that. So, do you think the UK's approach around pensions then is wrong?
No, the UK is doing it wrong. You do not want to have global investors that fail to diversify. What you want is to have your shares. The shares will exist. It's a question of who owns them. And what you want is for people from outside the UK to want to buy shares to the same extent as British people might want to buy shares from other countries. So I think good practice for managing pension funds, and what the sort of more senior members of your audience should want is to avoid this pressure to invest locally and to invest globally and to maximize diversification.
Yeah, it's a shame that it's happening within the default funds, which are by design the funds that people just get slapped in that don't know what's going on, and then they're being dictated to around.
But most of those people are people who either work for or did work for British companies. They are already overexposed to the performance of Britain. If Britain does well or does badly, people in the country will do well or do badly on balance. So there's an argument as to why people in that position should want to have international exposure. So I think the home bias that's being encouraged by the government is a mistake.
Have you got examples of markets where that's been attempted before, where what I get the impression from Rachel Reeves is almost like we want to jumpstart the UK market, because if we put pension funds into them, maybe the prices go up then, and then that makes it more attractive to international investors. It's like a chicken and an egg thing, isn't it?
I don't think she could believe that it will jumpstart the market, because pension funds in Britain, which were once very large, are not very large now. So we're talking about either defined benefit plans, that's the pension you get if you are in a long-standing, for example, public sector pension plan, and those are getting less important, or they are defined contribution plans. Those are ones where you as an individual decide how your money will be invested, and what you're describing as organizations where there is a default, you do usually have some choice.
You can choose. It's unfortunately most people don't.
And those people probably should be trying to invest internationally, because institutions can invest internationally at a lower cost than individuals who, if they've got an ISA, are more likely to be investing locally. So that they are exposed to the UK economy and probably more likely to buy a FTSE 100 or some other British exposure for their investments. So probably they would be better served by having exposure which is ex-UK. You actually blew a little bit hot and cold about the ex-UK chart that you had at one stage.
You know my content better than I do. This is super impressive. Thank you. Yeah. Do you feel that your work is anyway misrepresented or misunderstood? Is there anything that you'd like to say to people about the work that you do and how they should absorb and use it?
Well, I think I'm probably speaking for my two co-authors, Paul Marsh and Mike Staunton, as well as myself, that we want to portray the data. We will torture the data to give us answers to contemporary questions. But we don't produce forecasts, and we don't give recommendations except of a very light touch nature. So people who want to look at the book, I brought a copy with for you.
Thank you.
The book itself looks at all sorts of different issues, and you might encourage them just to learn more for themselves. But I don't think we are misrepresented. Sometimes people use our data in a way that we wouldn't use it. So, for example, I gave you the illustration of Australia, which has done very well. People grab that. And I think sometimes people rely too much on individual countries. They should be looking more at our world numbers and then adjusting them a little bit. If you focus on individual countries, you could take one country like the Netherlands, which has had very good investment performance, and a country like Belgium, which has had lower performance. And if you were just looking at the stock market as a guide to where you should invest, if you were trying to work out whether you should build a warehouse on a road somewhere near the border between the Netherlands and Belgium, you wouldn't want to have a different cost of capital for one that's 100 meters down the road that way or 100 meters the other way. You'd say that they must surely be evaluated in the same way. So there is a danger from focusing on individual countries, and yet the different experiences of these countries. So we have altogether, including equity markets which don't have bond markets, over 90 markets altogether for which we have data, but not going back 125 years. You could learn something from seeing what the different experiences of different markets. I think that's important.
Does it not matter how big the country is if you say don't look at countries overall? Because for example, America, California is the same GDP as lots of countries, or bigger than lots of countries. So does it not matter if the country's bigger?
Well, I think the stability of the United States, which is bigger than all the other countries put together in stock market terms, does make it less problematic if you have home bias in your portfolio than would otherwise be the case. And many countries have a large proportion of their stock market represented by companies that are just in 2 or 3 industries.
Yeah, something from the research was the concentration of certain markets is. I constantly hear that America is so concentrated, over concentrated. Then you look at other markets and you realise there's concentration issues.
It's one of the least concentrated
markets. Is great, yeah.
But the reason people think that America is concentrated is that large companies are American. So of the 10 largest companies in the world, 9 are American, and 1 is in the Far East. It's a problem that you should want to have. America is so broad that it provides enough diversification compared to what you would find in any other single country. But if you had lots of initiatives to drive people towards home-biased portfolios, that for some countries could be very costly. It could drive them into just a couple of sectors.
Have we seen concentration of the levels that we have now throughout history? Would you say, going back, that you always experience that the winners win in a sense?
No, the last few years have been remarkable for large companies doing very well. So those large companies were American, and excluding the year that hasn't finished yet, the recent past, those large companies had got bigger and bigger, and they got bigger because they were bigger, but they're also their performance was high, and so they've had a huge impact. And the net effect is that America, at least until the beginning of this year, was getting stronger and stronger in terms of its investment returns and its overall value. So this question of concentration is something which should concern people, but those who worried about being overweighted in American stocks year after year after year for quite a number of years in succession were worse off if they tried to underweight America because it looked so big. It's very difficult guessing which markets will do best. Market timing is costly, and buried inside those decisions to reallocate money from one market to another are costs that you never really see.
Damo, what do you think about that? You're a big fan of Elroy Dimson's work.
Massive fan of Mr. Dimson and his colleagues as well. There's three of them that were part of it. But yeah, it was kind of surreal to sit there with someone that I've quoted their work in a lot of my content, and for him to spout off a load of my videos because he'd been watching my stuff. And yet again, a world-class expert sits there and talks about buying a global index fund. I feel good.
You know? Pretty reassured you built your whole life around it.
Yeah, I do think that people need to listen to that point though around market returns and how he expects them to maybe not be as good in this century as they were before. I think a really useful exercise is to get a good compound interest calculator and just play around with different figures at different levels so you can make sure that you're on track with your goals. If I do say so myself, we have a really good one. I'll link it below. You can add fees into it, and it'll track inflation and these kind of things.
You're going to stress test it with different amounts, so it's not just the 10%. You can change the...
Yeah, the real returns he was talking about at nearer 5%, and then tweaking that down and up, just to make sure you're on track, because I do think one of the mistakes that people make around his work is they just quote the headline figures without acknowledging that certain centuries weren't as good.
Yeah. And focus on America and not global. Like, yeah, there's a lot of different returns.
Yeah, they focus on America.
They focus on
you were telling people to do that.
Everyone focus on, no, don't. Focus on global, that's what we think. Well, that's what we do.
Yeah, that is what we do.
Yeah. But we don't give financial advice.
No.
That's what we don't do.
No.